Joining us now to discuss the potential economic impact of these U.S. auto tariffs is Thomas Feltmate, senior economist with TD. Thomas, thanks so much for jumping in and joining us today.
Thanks for having me, Greg.
This is big news that has been telegraphed. Of course, now that it's here, we just got to figure out the significance of this for Canada's auto sector, especially from an employment perspective. What are you thinking?
Yeah, I mean, if we kind of take a step back and we look, the auto manufacturing sector accounts for about 3% of overall GDP in Canada. From an employment perspective, we're talking about 125,000 that work directly in auto manufacturing, probably another 500,000 or so in related industries. So not insignificant by any stretch of the imagination, but when we're talking about a Canadian economy that's employing over 21 million people, it's not necessarily in of itself right now going to have a meaningful impact, I would say, just yet. But again, there's a lot of uncertainty with these tariffs and how long they're going to be in effect for. We've seen so far the administration make announcements on tariffs. They come in, they come out, they come in, they come out. So we're going to need a little more line of sight, I guess, in terms of the duration of these tariffs. But as it stands today, wouldn't necessarily see a meaningful impact if they were only temporary.
Okay, let's talk about that, the broader economic implications, because you said we do have this uncertainty. If they're only temporary, then we're not going to get hit. What if we take the president at his word, saying there's no room for negotiation here? These auto tariffs are here; they stay. If we start getting months out, what do we start thinking about the Canadian economy?
Yeah, I think certainly we could start to see some production idled or reduced just because there's going to be some price impacts immediately felt in the U.S. So that's going to be felt, I would say, immediately through that demand channel. So production could respond pretty quick. And there could be some kind of knock-on effects if this were to persist for some time, right? We start to see hiring in the sector slow. We could see some outright layoffs. And then we get into kind of more specific economic impacts, more specifically in Southern Ontario, where a lot of the auto manufacturing is related and located. So there could be really meaningful impacts there as this kind of drags on longer. If these tariffs did prove to be kind of more permanent in nature. Also worth noting that we don't know what Canada's retaliatory measures are going to be just yet. Those are going to be announced next week after the U.S. announces further reciprocal tariffs on more of its trading partners. So up to $125 billion worth of goods imported into Canada could be subject to further tariffs. If some of those kind of include kind of a tit for tat on the auto tariffs, like what the U.S. has just put in play, we could see some meaningful price impacts here as well. So you think more through that kind of consumption channel, there could be a demand hit, and that could certainly weigh on growth as well.
Do we start worrying, Thomas, about inflation reigniting? I mean, we already know it's after the GST holiday passed that we did see an uptick in Canadian inflation. We start talking about tariffs on one side, tit-for-tat measures. Do we need to worry about that?
Absolutely, yeah. So like I said, right now, we don't have much line of sight in terms of what those retaliatory measures are going to look like. Based on what the U.S. has announced already with these auto tariffs, and we're pretty conservative in our assumptions here, the price impact could be pretty significant on new vehicle prices in the U.S. We could see a rise of up to $5,000 just on the tariffs on the final product. That's not taking into consideration the additional 25% on parts and components, nor is it taking into account the steel and aluminum tariffs that also came into play. So that kind of $5,000 increase in that average sales price is kind of the floor, and we could see it actually meaningfully move higher than that as well. If once we get a little more line of sight in terms of what these tariffs on the parts and components are going to look like, what's USMCA compliant, if there will be any exemptions there. So from an inflation standpoint, we're talking, that price shock alone of just $5,000 on your average new vehicle price could lift annual inflation by as much as half a point just from that alone. So significant upside risk there. And then again, if Canada were to kind of move in a tit for tat measure on imports of U.S. autos, we could see kind of a similar impact here in terms of inflation as well.
With all the talk of tariffs in recent weeks, there's been a lot of talk, too, about what governments could try to do to mitigate the impact. What tools do they have?
Yeah, so right now we've heard from the federal government a few days ago. They announced a $2 billion kind of strategic response fund that's going to be directed specifically towards the auto sector. We don't have a lot of information or detail on what that's going to look like yet. But generally speaking, what the federal government is saying that this is going to be meant to kind of strategically build out supply chains in Canada, try and insulate us a bit more going forward so that we can have kind of our our own fully integrated supply chain, insulate us from the U.S. a bit more and these kind of further tariff shocks. So certainly that's one thing. I think in terms of the near term, there could be some money built in there in terms of employment insurance as well, if we were to see these tariffs persist and it start to have kind of a more meaningful impact on layoffs as well.
All of this, of course, is a shock for us in this country in terms of our economy and where we might be headed. What about the U.S. economy? I mean, it was extremely resilient for the longest while. Where could things be headed there?
Yeah, absolutely. We're seeing a lot of resilience in the U.S. economy over the last couple of years. We've baked in some pretty conservative tariff assumptions here over the next couple of years, assuming that the U.S. kind of continues down this path of raising tariffs on some of its main trading partners. China, we've already seen that tariff rate go up by 20 percentage points. Europe, we expect next week, and the reciprocal tariffs could go up to 25%. Canada kind of hanging around 12 to 14% is where it could ultimately peak out this year. I think what's unknown right now is the duration of these tariffs, and that certainly has kind of that will have some impact on how the outlook kind of shakes out over the next year. We've already made a pretty meaningful markdown in our growth forecast for the U.S. on a Q4 on Q4 basis. We have it running at about 1.5% this year, so down about a percentage point relative to last year, where it was running slightly above trend at 2.5%. When we're looking at labor market metrics, we are starting to see some cracks forming in the labor market. Broader measures of unemployment are picking up. The Challenger job cuts data last month were pretty significant. We saw job cuts rise to the highest level since 2009 if we kind of strip out the pandemic. So we are starting to see some cracks forming there. A lot of it is kind of related to some of the federal job cuts that we've seen so far. So whether we see that kind of quiet down a bit remains to be seen. But I think a lot of this uncertainty that we're seeing through these tariff announcements could have a pretty meaningful impact on consumer decisions, whether or not businesses choose to invest as well, and that could certainly manifest in weaker growth over the next several quarters. So I would think right now when we're looking at the balance of risk to the economy, it is kind of skewed a bit more to the downside, but we're just going to have to wait and see how things play out here over the next couple of months with these tariff announcements.